Another ratio which may be considered as both liquidity ratio and activity ratio is inventory turnover, because it measures the activity or liquidity of an entity's inventory. This ratio indicates the efficiency of inventory management and measures the number of times on average inventory is replaced during the period. It is computed by dividing the cost of sales or cost of goods sold by the average inventory. It is important to point out that this formula is applicable for a merchandising concerned business. For a manufacturing business, which carries three major types of inventories, namely raw materials, goods in process or work in process, and finished goods, a turnover figure is computed for each inventory type. For raw materials turnover, the formula is cost of raw materials used divided by the average raw materials inventory. For goods in process turnover, the formula is cost of goods manufactured divided by the average goods in process inventory. While for finished goods turnover, it's cost of goods sold divided by the average finished goods inventory. From the name of the turnover ratio, we get an idea about its denominator. Raw materials turnover, so the denominator must be average raw materials inventory. Goods in process turnover, so the denominator must be average goods in process inventory. Finished goods turnover, therefore the denominator must be the average finished goods inventory. Raw materials must be used in the production of goods. Hence, the numerator, cost of raw materials used. Goods in process must be continued to be manufactured for them to become finished products. Therefore, the numerator, cost of goods manufactured. Once the goods are finished, they are then sold. Hence, the cost of goods sold as the numerator for this type of ratio, finished goods turnover. Going back to this formula for a merchandising business like Elizabeth Tailoring Materials Store, just like the other ratios I've discussed so far, please realize how easy it should be for you to keep this formula in mind. From the name of the ratio, inventory turnover, it should be obvious that the denominator must be the inventory. Only use the average inventory figure. I discussed the use of average in part 2 of this lecture series. Remember? How about the numerator? How can we easily remember that the numerator must be the cost of sales or cost of goods sold? Simple. Just recall one lesson you learned before, which I elaborated in the video about periodic system and perpetual system. When merchandise inventory is sold, the asset merchandise inventory becomes an expense. Specifically, what kind of expense? Cost of sales or cost of goods sold. That's why the numerator must be cost of sales. When inventory is sold, it becomes cost of goods sold or cost of sales. Hence, the numerator is cost of sales or cost of goods sold. Now, Elizabeth tailoring's cost of sales for 2022 is 4,050,000. Its merchandise inventory at the beginning of that year is 1,200,000, while the ending figure stands at 950,000. $1,200,000 beginning inventory plus 950,000 ending inventory divided by 2 gives us the average inventory, which when used to divide the cost of sales of 4,050,000 provides us with the inventory turnover of 3.77 or 3.77 times. Because again, inventory turnover measures the number of times on average inventory is replaced or sold during the period. Generally, the higher the inventory turnover is, the better. That is generally speaking, because a number of factors must be taken into consideration in determining a satisfactory figure for inventory turnover. As stated earlier, the inventory turnover measures the number of times that inventory is replaced during the period. Therefore, a very high inventory turnover ratio means that it is very much possible that the inventory may run out of stock, which may result into losing some customers. On the other hand, a very low inventory turnover indicates that the entity is keeping the inventory in stock for quite a long period of time, which necessitates additional cost, like storage cost, maintenance cost, and insurance cost. Another factor to consider in determining the desirable figure for inventory turnover is the nature of a company's business. Entities selling food and other perishable items, as well as goods which shortly become obsolete or are highly affected by changes in style or fads, like ready-to-wear clothes or even cellular phones and accessories, definitely require a very high turnover ratio. Likewise, businesses selling products with minimal markup and heavily relies on high volume sales to earn high profit need a very high inventory turnover ratio. On the other hand, companies selling items with high markups and or goods which are not perishable or subject to obsolescence do not need a very high inventory turnover figure. The resulting inventory turnover must likewise be compared with that of other entities in the same industry or to the entity's past inventory turnover figure.